Navitas Semiconductor concluded its last live market session on Friday, May 15, 2026, at 4 p.m. EDT, with the stock closing at exactly 21.32 per share, representing a sharp intraday drop of 4.48%. This daily loss follows a highly volatile trading week that saw the equity pull back from its fresh 52-week high of 23.82. While the headline figures point to a standard tech sector pullback, the underlying trading dynamics tell a completely different story. Behind this single-day dip lies an aggressive institutional chess match triggered by an at-the-market equity offering program initiated just days earlier. Savvy market participants expected the newly announced capital raise to heavily dilute shareholders and crush immediate price momentum, but instead, large block orders over the week demonstrated massive institutional accumulation that absorbed the initial selling pressure. This unexpected volume spike reveals a deep divergence between retail sentiment, which panicked over the stock issuance, and sophisticated funds that are aggressively repositioning their capital. When you evaluate a volatile mid-cap asset like this, there is always an intense psychological friction between short-term market expectations and structural reality. The prevailing expectation among retail participants on active investing sites is that the company is riding an unstoppable wave of artificial intelligence hardware demand, viewing it as a direct proxy for high-power infrastructure expansion. The narrative across retail trading rooms suggests that any pullback is merely a buying opportunity. However, the reality hidden within the latest financial statements points to a precarious transition phase. The company intentionally walked away from its legacy consumer mobile charging revenue to chase high-power infrastructure designs. This tactical shift caused immediate quarterly revenues to slide significantly before the new data center contracts could fully scale. If you are tracking this volatility on your chosen investment app, you are witnessing a high-stakes transition where the company is intentionally burning its old revenue base to build a more lucrative enterprise foundation. Comment below how many shares of Navitas Semiconductor you currently hold in your portfolio to help gauge our community's positioning on this chip play. The recent trading volume reveals how intensely this asset has captured institutional attention. Throughout the early weeks of May 2026, daily trading volumes routinely eclipsed 35 million shares, a massive surge compared to historical baselines. This liquidity explosion directly correlates with the company entering a sales agreement with major investment banks to opportunistically sell Class A common stock directly into the open market. Traditional market expectations dictate that an at-the-market program creates an artificial ceiling on stock price as the continuous supply of new shares dampens upward momentum. Yet the reality of the price action surprised the broader market when a product partnership announcement with an overseas hardware developer triggered a staggering single-day rally of over 24% just days ago. This violent upward move suggests that short interest, which recently hovered around 21% of total outstanding shares, is creating an explosive coiled spring effect. When good operational news hits the wire, short sellers are forced to frantically cover their positions, purchasing shares directly from the open market and amplifying the upward swings. This structural volatility makes navigating the stock incredibly complex for individual brokerage accounts. On one side, quantitative models published across popular investing sites flag the equity as severely overvalued based on current trailing metrics, pointing out that its multi-billion-dollar market capitalization sits at an extreme multiple relative to its annualized revenue. Wall Street analysts maintain a consensus price target far below the current market price, with some firms pricing the fair value in the single digits due to near-term net losses. On the other side, institutional tracking data shows prominent global asset management firms aggressively adding millions of shares to their portfolios over recent quarters. This creates a fascinating divergence where traditional valuation models scream caution, while massive institutional accumulation signals deep long-term conviction. To understand why this friction exists, you have to look closely at the underlying financial performance reported in their latest first quarter update. Sequential revenue managed an 18% increase, driven primarily by an expanded gross margin profile. This margin expansion occurred precisely because high-power enterprise markets, including artificial intelligence data centers, grid systems, and industrial electrification, now represent more than half of the company's total sales mix. The core bull thesis is that these advanced power systems require specialized wide bandgap materials that far exceed the performance capabilities of traditional silicon chips. In highly demanding data center environments where power density and thermal efficiency directly dictate operating costs, these advanced power chip designs are becoming critical infrastructure components. However, the bears point to the sobering reality of the current income statement to justify their short positions. Total operating expenses scaled significantly higher over the past quarter, driven by elevated research and development spending and rising administrative costs. This resulted in an operational loss that underscores how capital-intensive this semiconductor pivot truly is. The company is required to commit massive amounts of capital toward designing advanced components, all while its legacy consumer revenue continues to taper off. This creates a critical race against time. The company must successfully ramp up its enterprise data center shipments and secure commercial design wins before its cash reserves require further dilutive financing rounds.
The broader macro environment adds another layer of pressure to the situation. High interest rate environments naturally penalize growth-oriented tech companies that defer their true profitability into the future. When capital is expensive, institutional investors become far less patient with firms reporting net losses, demanding clear timelines to positive free cash flow. This macro headwind explains why the stock experiences such severe daily swings. Any broader market rotation out of speculative technology assets immediately puts pressure on this equity, forcing self-investing individuals to weigh the long-term technological promise against immediate balance sheet realities. This brings us to what the company actually does and how its core business model functions. Founded to pioneer next-generation power electronics, the firm specializes in designing gallium nitride and silicon carbide power semiconductors. These materials possess a much higher band gap than standard silicon, meaning they can handle significantly higher voltages, currents, and switching frequencies, while wasting far less energy as heat. The original business model focused heavily on integrated circuits for fast charging adapters for smartphones and laptops. While this provided quick volume and initial commercial validation, the consumer electronics market is notorious for razor-thin margins, cyclical downturns, and intense pricing pressure from large hardware clients. Recognizing these limitations, management executed a sweeping strategic pivot to re-engineer their wide bandgap technology for massive high-power applications. Today, the core operational focus is centered on supplying specialized power delivery platforms for advanced computing architectures. In standard data center setups, power must be converted multiple times as it steps down from high-voltage utility lines to the delicate low-voltage processors inside a server rack. Each conversion stage introduces energy loss and generates heat. The company's latest technological developments focus on eliminating intermediate conversion steps, delivering high-voltage efficiency directly to the computing board. By reducing energy waste, data center operators can cram more computing power into a smaller physical footprint without overwhelming their cooling infrastructure. This technological edge is the primary reason why the stock is decoupled from traditional valuation metrics and became a highly watched asset across electronic trading networks. Looking ahead, the forward-looking outlook remains entirely dependent on how reality measures up against the current market narrative. There are two primary scenarios that investors must carefully monitor. The bullish scenario relies on the rapid commercialization of their newly showcased power delivery boards. If major cloud service providers and graphics processor manufacturers formally adopt these wide bandgap designs as a standard configuration for next-generation server clusters, the company's revenue could experience an exponential acceleration. This outcome would quickly validate the expensive strategic pivot, compress the current valuation multiples, and force a massive structural re-rating of the stock. Under this scenario, the current capital raises through the at-the-market program will be viewed in hindsight as a necessary and brilliant tactical move to fund production scaling ahead of a massive demand wave. Conversely, the bearish scenario hinges on execution delays and intensifying competitive threats. The semiconductor industry is fiercely contested, and legacy chip giants with massive balance sheets are actively developing their own competitive wide bandgap portfolios. If larger, well-capitalized competitors introduce alternative high-efficiency power modules at a lower price point, the company could see its anticipated market share erode before achieving true scale. Furthermore, if cloud infrastructure capital expenditures slow down due to a broader economic cooling, the timeline for data center design wins could push further out into the future. This delay would force the company to rely even more on its share issuance program, causing continuous equity dilution that would severely penalize long-term holders. Ultimately, the central tension for the stock comes down to timing versus valuation. The market expectation has priced in a flawless execution of an industrial turnaround, viewing the company as a key beneficiary of the global build-out of computing infrastructure. The reality reveals a business that is actively operating at a loss, navigating a profound product transition, and utilizing volatile market conditions to opportunistically raise capital. For investors tracking these metrics across modern electronic trading systems, the core question is whether the technological superiority of these advanced power chips can translate into profitable commercial scale before competitive pressures or dilution break the momentum. The deep institutional interest and massive trading volume confirm that the market is actively processing this calculation, turning this specific equity into a fascinating battleground between short-term fundamental skeptics and long-term tech visionaries.